Hi, I'm Keith McCullough, and welcome back to Real Conversations, where I'm excited to have my friend and market historian, strategist, everything that you want, really, in terms of somebody actually telling you what's going on, historically putting it in context, Mr. Jim Rickards. Thank you for coming back. We appreciate it.
Thanks for inviting me, Keith. Great to be here.
The book, last time we talked, your book was just being introduced now. It's gone to paperback, The Death of Money.
Right.
So I just wanted to kind of get your quick take on how it went. And, you've written a couple quickly here. So.
Right. I had two new releases in 2016, which I'll never do again. It's just brutal having two books in 1 year. But the New Case for Gold came out in April, and The Road to Ruin came out in November. But the book that's out now is the paperback of The Death of Money. That originally came out in 2014.
Right.
It's now out in paperback. A lot of times I'll have a paperback within a year. This took 3 years because it was, frankly, selling very well. But we have a new preface in the book with brand new material. So
really?
For those who didn't buy it the first time, or even if you have the hardcover, there's new stuff in the paperback about insider trading ahead of 9/11. What happened is I wrote a chapter in the book about insider trading for 9/11, my involvement with the CIA and Project Prophecy, and that was pretty detailed. After that was published, people started coming forward, reaching out to me, saying, I saw some insider trading, let me tell you my story. And candidly, one guy, he really wanted, he didn't do anything wrong, but he wanted to unburden himself, in effect. He told me his story in tears. And I included that in the book, so it adds to the weight of the case, which is really beyond debate. There clearly was insider trading. But there's some new stuff in the paperback of The Death of Money.
Did you use his name, or did you keep it in
I don't use names in situations like that. But he's a very well-known top sales trader, one of the primary dealers, and he covers sovereign wealth funds. So he covers the biggest accounts in the world. So this guy's a serious player in the U.S. government securities market. Basically got a $2 billion order for 2-year notes the day before 9/11 from an account who had never called him before, and it was a Middle Eastern sovereign wealth fund. So nobody, $2 billion. That's even in the Treasury market. That's a big order, so that was very clearly insider trading.
Well, guys like us would have never believed there was insider trading, would we?
Well,
how about the Fed now? They're actually acknowledging that they leaked to. I think it was a legitimate leak, and he had to. I don't know if he had to resign, but
what Lacker did was he was not forthright when he was asked about it. It wasn't clear that he was the leaker. I think the leaker was in New York, but they had an internal investigation. He was asked about it, and he had spoken to Richard Medley, who's the guy who got the leak, the beneficiary of the leak, and kind of lied to the investigator, which is a felony, by the way. He's not going to be prosecuted, but when you lie to a U.S. investigator, Title 18, Section 1001, that's 5 years in jail. So, so you can see why he had to leave.
This is the lawyer, Jim Rickards, that once was.
I am a lawyer, too, in addition to a lot of other things. And Section 1001, Title 18 is the federal government's favorite tool because you don't have to do anything wrong. You just have to lie to an investigator. So you're innocent, but the guy asks you a question and you're not forthright. That's a felony.
Yeah, wow. One of the biggest things before we get into kind of market topics and whatnot that I just feel like I have to address, because you and I, being active in the Twitter sphere, we actually engage with people. You're very good with that. You're not shy, and you don't use any kind of language that's ridiculous or anything like that. You stay to what you know, and you continue to pound what you think could happen. And I think that that's admirable. I mean, there are a lot of people out there that will get things wrong and get things right. They kind of, they bluster and they're pundits, but they really don't have a process. They don't have a framework.
Right.
And what I try to do is find people like you that actually have a process, have a framework. You're one of the most unique people out there in terms of having your entire history from long-term capital management, like you said, being counsel to becoming who you are today. So I find it difficult to accept tweets that, somebody tweets me and says, Jim Rickards has had it wrong. The world didn't end yesterday.
Well, I never said it would end.
No, exactly. So I wanted to just give you a chance to, like, even if you do or you don't, maybe I'm in this mode because I just read Joe Buck's book, where Joe Buck actually acknowledges that, sometimes we are affected by feedback, even because we're humans. And I wonder if you ever are, and how you think about it.
Well, to be candid, it's a great question, Keith, and I am very active on Twitter. It can wear you down a little bit, and people love to put words in your mouth. I have never said the world's coming to an end.
Exactly.
I have said we are poised for a systemic crisis in financial markets bigger than anything we've ever seen before. I have said that, and I still say that. We are in that position, and we don't have time, but I could give you a 3-hour science lecture on why that's true. I have said that, but I have
You've also said it before we've had major market meltdowns. So I mean, it's not like we haven't had it.
I was out in 2005. I was a regular lecturer at the Kellogg School of Northwestern. I was the Applied Physics Laboratory, School of Advanced Mathematics. I was talking to classrooms. I wasn't on television, but I was saying, because I lived through '98, and I spent 5 years at the long-term capital management crisis. I negotiated that bailout. I was the lawyer, not the risk manager, but I wasn't entirely pleased with the outcome. I don't fault anyone but myself. But for my own intellectual curiosity and satisfaction, I spent 5 years. Because, you know, I mean, I used to share an office with Myron Scholes and Bob Merton, and you know, we had the fathers of modern financial theory. We had 2 Nobel Prize winners. We had more IQ points. The average IQ is kind of 160 in the room. And so they weren't dumb, and they were the thought leaders, and they got it disastrously wrong. So all I said as a PhD, I said, well, if the smartest people in the world got it wrong, what are they missing?
Right.
And I spent 5 years studying physics, applied mathematics, network theory, graph theory, behavioral economics, complexity theory, and a lot of other branches of science to understand what they got wrong, figure that out. And so did our friend Nassim Taleb. He got to the same place with the Black Swan. But what Nassim did in the Black Swan, he said, okay, none of this works. This is all garbage. He was right. Threw up his hands, walked away, said, I'm a philosopher. I don't have to deal with this.
Like, and in almost, I think many would say, and he would probably agree, in kind of an angry way.
Yeah, angry and a little disdainful. And I don't get angry, but I don't disagree with his conclusion. But where I parted ways with Nassim, I said, okay, this doesn't work. Got it. What does work? And then I spent another 5 years working on those models, and I've had very good results with them ever since. So, thank you for pointing out that I do work within a framework, as do you. So, but when you go out there on Twitter, so that's the first thing, you know, you're saying the world's coming to an end. Never said it. Don't believe it. By the way, I do say
people want to put you in a bucket because it's easy
correct,
to do.
Correct. The other thing is say Jim Rickards says sell everything, buy gold. Never said that. I do recommend a 10% allocation to gold.
You've always said that. Yeah.
Right. Well, that leaves 90% to go buy stocks and bonds and do anything else you want, right? So and so I would say if you have 10%, sit tight. By the way, 10% of investable assets. So put your home equity and your business equity to one side. If you've got an auto dealer or a pizza, I mean, you deal with high-end hedge fund clients, but my audience is more everyday Americans. If you're an auto dealer, don't count your business equity. Put that to one side. What's left of your investable assets? Put 10% in gold. If you've got 10%, sit tight. That's your insurance. You'll do fine. If you don't, then look for entry points, which mid-December, I said good entry point, and I persisted in that, and that has done very well. Gold's up 15% since that 1150 low. So yeah, I don't say so. Yeah, people want to put words in your mouth. I do tell people, if you want to know what's going to happen in the next 4 years, read my books. If you want to know what's going to happen in the next 30 years, read Lionel Shriver's book, The Mandibles. She's a novelist, a good one. She's won a lot of prizes. She has a book called The Mandibles, and it's 4 generations of an American family from 2029 to 2049. So it's in the not too distant future. But she's writing about life in a post-financial crisis America. So the financial crisis that I'm forecasting, she says, okay, that happened. What is life like? And the point she makes, and I agree with her, is that life goes on. It's just different. So, you still go shopping, but the shelves are kind of bare. So it's more like Venezuela. And we still have police, but you have to pay them to patrol your block. So it's more like like a third world country. The population is majority Hispanic. So there's President Alvarez. He gives the State of the Union address in Espanol, mis amigos americanos, and then the world went to something like an SDR, but America didn't. And so we had to redenominate the US dollar with hyperinflation, which wiped out a lot of wealth. But because it's a new dollar, they call it nuevos. So it's a really fascinating study. Now, I'm not saying the world will play out that way in every detail. What I'm saying is, if you want to see what it looks like in a post-systemic crisis America, great treatment.
Well, I think that, to me, that's super important when, again, it's a framework with a duration.
Right.
Like, I operate in multi-duration, multi-factor space. That's what somebody who's trading markets does.
Right.
Last I checked, that's not what you're doing. You're not sitting there running a hedge fund or day trading gold futures.
Right.
But people ask me, what do you think on gold when it's at this level or that level? That's what I do. What I think more and more people should do is find people that have clean, clear, concise frameworks on the duration by which they've defined it. Everything else, so if you tell me that there's a novelist who has a 30-year view, and I tell you I have Neil Howe who's got an 80-year view, I'll read them both. I don't have to actually agree with every single day with that position.
Right.
And I struggle with that. Like, how many people out there? Maybe it's because the media has taught them how to behave, but I struggle with how to. Do we need to help them understand that we're just trying to help augment each other's views?
Yeah. If I say it looks like a good entry point for gold. Gold's going up, and it goes down the next day. You're dope. Hey, Jim, you're an idiot because no, because it's volatile. We could go up and down. I understand that.
But you're not afraid to say something there.
No, I mean, I was the great thing about doing a lot of television, you always say timestamp. I've got the video clips. I can okay. I was on Bloomberg March 2016 saying the UK was going to leave the EU.
Yep.
I was on with Alex Steele. I was in the London Eye, the Ferris wheel, on June 20th, 3 days before Brexit, saying, buy gold, short sterling. And I never yelled, but I was kind of like, buy gold, short sterling. After Brexit, gold went up 14%, sterling crashed 14%. Gold went up 8%, sterling crashed 14%. I got notes from people saying, thank you for paying for my kids' college tuition this year, because I followed that advice.
Because from time to time you'll make a call.
Yeah,
but the body of Jim, like when God willing you and I are around forever, but forever is not a realistic duration in our good lives. I mean, when we're gone from this game, I would much prefer people remember you for everything that you've contributed as a body of work across disciplines and as an author and as a teacher than trying to make like one-off calls. I mean, hopefully my legacy is the firm that I build, but I mean, if I get evaluated on I have 3,800 timestamps.
Right.
You know what? There's some horrible timestamps in there. There's in fact many
Sure.
horrible timestamps. So I wonder if you've thought about that.
Yeah, well, you know what, you're absolutely right. So you go to Twitter, and Twitter, by the way, I think I use it a lot, and I'll continue to use it, but it's become way too political, way too many robots. I mean,
right.
a big majority of the notification I get, I know they're robots. I mean, Obama had a good robot operation. Putin has a very good robot operation. I'll say something about Russia, and I'll get 30 tweets. So it's like, I know you people aren't following me, but you are robotically scanning 200 million Twitter feeds in real time with a lot of computer power,
right.
and you know I stepped out of line according to you, and it came back. Now, like I care, right? I don't really care what they say, but a lot of people do. A lot of people cannot. It's an intimidation factor. Like, oh, gee, I said something wrong.
Right.
They won't say it again. And that intimidation factor, that kind of neo-fascist bubble has really infected Twitter, unfortunately. I'm pretty good at spotting robots because I've been doing this since 2009, but
right.
I don't blame people for being a little beaten up. So that's the bad side. The good side, I got an email from a gentleman this morning who is severely dyslexic, and he thanked me for doing the audio version of The Road to Ruin.
Oh, really?
Because we have audiobooks on all the books, but the last couple I've done myself, and it's hard. You go in the studio for like 3 or 4 days.
Yeah.
I had the like Stanley Kubrick of all voice coaches, voice directors. He would make me do it over again because he couldn't hear the D in connected, So, but anyway, we go through that, and he said, "Thank you." Because when it's read by the author,
way better.
You get a lot of nuance that you
way better.
Don't get from anyone else.
That's like, as I mentioned, this Joe Buck book.
Yeah.
Because I try to read 2 books at a time. It's a little bit too much detail, but you can do that if you're listening to one on Audible when you're running or walking or whatever you're doing. So Joe Buck actually read his book. And that was super important. I mean, the guy's dropping F-bombs and everything else, and it does actually, it's kind of entertaining to hear the guy that I think he's a great broadcaster.
I agree. Yeah.
But for him to be so, for a guy to tell it like it is through his own voice is invaluable.
Right.
So that's a great thing. You have to do this now for every book, I guess.
I've done the last 2. I'll keep doing it. Actually, it's hard work, but I actually like doing it, and I know the readers appreciate it. But those little thank you notes that come in,
that's awesome. Yeah.
That offsets all the trolls and the robots and all that stuff. So.
Yeah, that's good. Well, getting back to what people really care about, which right before we came in here, you said you wanted to talk about your view on kind of Fed fund futures mismatches. You were one of the only people who said before, it was like one of the most epic moves in short-term Fed fund futures, that March move. But you, from the beginning, said, look, the Fed's going to raise in March. What do you, McFly?
Right. Beginning, and again, I have newsletters, I have TV interviews, so this is all, as you say, timestamp. So end of December, so the Fed's going to raise in March.
Right.
The market gave it a 28% probability. So just look at the Fed funds futures implied probability of a March rate hike from December to March. Just look at that chart.
Yep.
It goes like this, 28, 30, all through January, all through February, until the last 2 trading days of February. Then it goes boom, it goes vertical, ultimate hockey stick to 90%. So I started at 75% because I use Bayesian statistics, so I update. You never want to say 100, that's silly. I started at 75% in end of December. I got to 80, then I got to 90, and the market kind of came up and met me here at 90. Then we all got to 100 because the day before we all knew that the Fed was going to raise rates. So that gap, between 28 and 80 for 2 months that persisted. And I'm not smarter than anyone else. I have a model, which the Fed told me. It's not like I invented this model. Like the Fed is telling you what they're thinking, what they're doing, what they're looking at. It's just that nobody's listening. Right. And the markets, you know, I mean, you should only listen to 4 Fed officials. Listen to Janet Yellen, Stan Fisher, Bill Dudley, and Lael Brainerd. That's it. Dudley told me that. It's like, you know, dinner with him. He said, these are the only people you should listen to. He said, don't listen to any of the regional reserve bank presidents except me. And I agree with that. I have it from insiders at the board that they don't really. So, you know, they're all smart people. Like Loretta Mester and Esther George and Jim Bullard and Eric Rosengren are running around giving speeches. Save your time. You know, don't waste your time. I mean, again, smart people. I'm not saying that they don't have interesting views. They do, but they have no impact on policy.
Zero.
So look at those 4. They're the only ones who matter. And so it's really simple. You can do this at home. The Fed's going to raise rates every March, June, September, and December, 25 basis points until the middle of 2019, until they get to 3.25. So that's your baseline. They're just going to do that. There are only 4 reasons why they won't, but it's not data dependent. They told us the reasons. One is if you see job growth below 75,000, which is a very low bar. Like if jobs came in at 100,000, people get all spun out. Oh, gee, the Fed's not going to raise rates. No, it's 75,000. That's the number. The second one is if you actually have a recession, so 2 quarters of negative GDP. Right. 1 quarter is not enough because everyone will say it's weather related, you know, and all that jazz. So yeah, an actual recession, which would probably be too late then. The third one is disinflation. So they use, you know, PCE core year over year. So this is not me making up the tell us. This is our benchmark, right? It has been getting closer to 2%, which Yellen has been struggling to get to for 6 years, forever, right? If you see that back up, it starts going down, gapping down to 1.5, 1.4, that might be a reason to pause. And the fourth one is extreme tightening of financial conditions. By extreme, I mean Fed does not care if the S&P goes down 100 points. Does not care. Dow goes down 1,000 points. Doesn't care. If it's because that's a 5% move from current levels. If it's more than that and looks disorderly, so you see it draw down 6-7%, not just that over time, but it looks really disorderly. Like that would be a reason. And we saw 2 examples of that. August 2015, after the shock Chinese devaluation. On August 31st, 2015, if you were, you know, on vacation or taking your kids to school, it looked like there was no bottom. And then the Fed came in with a happy talk, the forward guidance, backed off on the September 2015 liftoff, which they eventually did in December, and that was enough to get the stock market going back up again. The other time, February 10, 2016, from January 1st to February 10, 2016, the market went down 11%. Again, looked like no bottom. And then they came out with happy talk in the Shanghai Accord, and what they did then was they weakened the dollar, and that had very powerful explanatory power from February to June. Huge. None of this stuff lasts forever, but the weaker dollar, stronger euro, stronger yen trade from the end of February, because they met in Shanghai and did this on the sidelines, to June again, and then that was enough to get the market back up, if you see that. So those are the 4 pause factors. By the way, look for the word pause, because that's the Fed's inside word. This is what Dudley said the other day. So they have 4 pause factors: an actual recession, job growth below 75,000 for at least 1, maybe 2 months, disinflation, PCE core year over year going the wrong way, or a greater than 5% drawdown that looks scary. Yep. If you see one of those 4 things, certainly if you see 2 or 3, they will not hike. If you don't see them, they will hike. And so right now, I don't see them. Stock markets, you know, it peaked March 1st. It's gone sideways since the middle of February, but it's not crashing. Disinflation, you know, take your pick. It looks like it's kind of hanging in there.
Well, on a reported basis, inflation, because it compares against the deflation of last year, the low prints, you're going to have year-over-year high inflation, even though market signals are starting to signal inflation.
Good point.
So those will be up.
Take that off the table. Job creation looks kind of strong. You know, it's not going to be below 75,000, and the other factors not in play either. So the point is, you don't see the 4 things that would cause them to pause.
So you think they just hike?
So you don't see a recession, you don't see a disorderly market, you don't see job creation fall below 75,000, and you don't see disinflation. So therefore, they're going to raise. It's simple. Now, what will happen is we'll get to the end of May, right? And we talk about the June meeting, June 14th.
Skip the May meeting, do the June.
Yeah, they won't raise in June. May, sorry, they won't raise in May. So we'll get to the end of May. The market's going to be poking around 30, 40%. They're going to do the same thing they did. They're going to give 4 speeches in 4 days. By the way, what was it that caused the Fed Fund futures?
You mean the market's poking around, just so that people aren't watching this? But I mean, or don't stare at Fed fund futures. You mean the market, the Fed fund futures are poking at 30 to 40%.
Implied probability of Fed fund futures, exactly.
So if it's not where it needs to be, then they got to hustle.
They'll make it. Why did it go from 30% to 90% in 4 days? Nothing changed. What happened was they gave 4 speeches. Lael Brainerd, Janet Yellen, Stan Fisher, and Bill Dudley all came out and gave speeches. And Yellen, I've never seen her more blunt. She said, "We're going to raise rates, pretty much." And the market goes, "Okay, we get it." Yeah. So this is like rope-a-dope. It's like the market keeps falling for the same. But so is the market dumb? It's not dumb, but here's what the market's missing. The market has the causality backwards. They assume that when the Fed raises rates, the economy must be strong. Well, if you do the regressions, 40 business cycles since the end of World War II, that has been true. There's a very high correlation, between the economy stronger and the Fed raises rates. But that's because the Fed follows the economy. The Fed never leads the economy. The Fed follows the economy. They raise them too late. They cut them too late. That's why we have these business cycles.
But they're pro-cyclical in market speak.
Correct. Until they're not, until they go too far. And then
embarrassingly pro-cyclical, and then they're the catalyst.
Right. So people are saying, okay, well, the Fed's raising rates, so the economy must be strong. No. They're raising, for the first time since 1937, they're raising into weakness. And the reason is that it has nothing to do with the business cycle. It has to do with the fact that they're playing catch-up for Bernanke's failure to raise in 2010, 2011, when he should have. If the Fed had raised 25 basis points every other meeting in 2010, the market wouldn't have cared. We were at the early stages of an expansion. Right. Now we're at the late stages of an expansion. This expansion is it's going to be 7 years old in 2 months. So it's
92 months.
Sorry, eight years old. I misspoke. So it's going to be 8 years old. Right, 92 months. Average expansion since 1980. Which is a period of long expansions, is about 80 months. Now, I take the point that expansions don't die of old age. I understand that. Australia has not had a recession in 25 years, so it can be done. But the fact is, this is getting long in the tooth, and there are lots and lots of. We haven't really got into the growth accelerating, growth slowing but there's lots of data, at least I see, that says that they're tightening into weakness, and they're going to cause a recession.
Now, the weakness that you think, and I think that people that are looking for you and I to jump up and down against each other are going to be sadly mistaken. But the reality is that our model, which is a predictive tracking algorithm, you're familiar with it. It actually has the biggest component of growth accelerating, which most people who don't model it either using base effects or Bayes, which we both use, I think.
Yeah, yes.
So Bayes for me is the 30 data points per month in the predictive tracking algorithm. So when I say that the growth is accelerating, it's accelerating against the prior year slowdown. Yeah. So what you actually have is the biggest slowdown, to your point, last year was really in the second quarter. So that to us is the most obvious rate of change acceleration. Right. So when I say accelerating, it's almost a mathematical certainty unless you have like catastrophic type data points.
Yeah.
So that's when I'm saying, just like you said at the beginning, to be clear, I didn't say that the world's going to end tomorrow.
Right.
When I say growth's accelerating, I'm just operating on the sine curve.
Well, just to be clear, anybody who woke up every day for the last 5 months and did what Hedgeye and Keith McCullough recommended has made a lot of money. And they've actually outperformed the market. You got this call completely right, but you did better than that because you said sell the dips, buy the rips. And market timing is the key to alpha. Bob Merton, Nobel Prize winner, has not a great risk manager, but a brilliant theorist and writer, a mathematician, has a 1980 paper. Said there are only 2 ways to get alpha: inside information, which can be legal. We don't like the illegal kind. Inside information and market timing, which are 2 sides of the same coin. Because if you have the legal inside information, you can time the market. Yeah. So buy the dips, sell the rips. Growth accelerating. If you just followed your advice, you've outperformed the market, and if you applied any leverage at all, because a lot of the hedge fund clients do, you've made 40, 50%, which annualizes at 80%. So credit where credit's due.
Well, thank you.
No, that's absolutely true. And
but I just sold everything yesterday, by the way. So I was waiting for you to talk me into why I don't. Because buying the dips, man, is not, as you know, because I'm in this fishbowl.
Yeah.
Twitter fully loaded. We've already addressed that. I don't even want to go there anymore. But it's not easy to buy every incremental dip, because every incremental dip that you buy, you're running out of runway on the top side. Because markets, even if I am right, and growth, and to be clear, I don't have growth accelerating until the year 2025. I mean, we got 2 more big quarters of acceleration against the slowdown last year. And markets have an uncanny ability, as you know, to start to discount something's already priced in 2 to 3 quarters away.
Right.
3 to 6 months is very common. Look at what happened with the reflation trade. It stopped going up right on time, right when the Fed said, well, look at that. PC finally, the dog finally caught the fire truck. We're at our target in inflation right at the top.
Right.
So I do worry about it. I mean, there's no doubt about it.
Well, that's another point. I mean, look, the stock market peaked March 1st, and it's about where it was today. It's about where it was in mid-February.
Yeah.
So
the S&P 500, the NASDAQ hit a new high.
Correct. That's correct. S&P 500, which I think is a better representation of the economy.
Which I don't like. I haven't
whatever.
wanted to be long the S&P 500. I want to be just long the crazy train.
Yeah. Well, that's worked.
Which is the NASDAQ.
That has worked. But the stock market generally goes down about 6 months before a recession. So you can look at this data, and I'm talking about the S&P, and say this is an indicator of recession. Now I said that, and I've called a recession for midsummer, based on my Fed model, which says they're going to raise in June. They're raising into weakness, and there's a lot of other factors we can talk about.
But is part of the recession call that they raise into any modest slowing or deflation of the reflation, and that's a domino?
Correct, because they are not raising for this. The reason they've raised for the last 40 years is not the reason they're raising today. Mm-hmm. There's this one-off, one-of-a-kind. I spoke to Bernanke, and he called this an experiment. I said, well, thank you, Mr. Chairman. So we're the guinea pigs? I said, did this work, this QE1? He said, we won't know until 30 years from now. This is what he told me. He said,
oh, boy.
Some future Ben Bernanke, because Ben Bernanke made his academic reputation on the study of the Great Depression, and that's the name of his book, The Great Depression, in following in the path of Milton Friedman and Anna Schwartz. Although Anna, till the day she died, had not good things to say about Bernanke. But so he said, in 30 years from now, some future Ben Bernanke, some young scholar, will look back at what I did and tell us if we got it right. And he used the word experiment. He also said, he told me, he said, it's better to do something than do nothing, which I completely disagree with. That's the opposite of the Hippocratic Oath. The Hippocratic Oath is, first do no harm, right? So I said, no, it's often better to do nothing than to do something if you don't know what you're doing.
Such a great thought.
Yeah,
in anything. I mean, I don't know why people don't use the lessons of life in the same way that they would operate from a risk management perspective, economically or market-wise. I mean, this morning, actually, I don't know if you've read this, but you probably have read this book by an Israeli soldier called Pumpkin Flowers. It's this new book that's...
I haven't read it. I saw your...
It's a pretty interesting book because, I like to put myself in a place that I don't live and try to empathize with what it is that's going on there. And, he basically, his number one point is that he specializes in waiting. Mm-hmm. Yeah, he's just sitting in this ridge waiting to be attacked. And every morning they wake up and they're not attacked. They do it all over again. Same regimen over and over and over again. But the whole concept of waiting and watching, why Bernanke never even considered that.
Right.
Or Paulson, any of these guys.
Yeah.
They believe fundamentally, and still today, every single thing I read in the marketplace is based on Trump acting or Yellen acting. People fundamentally believe that they need the government to act to create a certain outcome.
Correct. And Ben Bernanke grew up in South Carolina in the wake of the Great Depression. He's a Democrat and an FDR believer. And he told me, he said, I model what I do on FDR. And you look at FDR, I mean, there was a reason that the Great Depression was not over in 18 months. There's a reason it lasted 11 years and not 11 months. Yeah. Because Hoover and FDR were two peas in a pod. They just kept trying stuff, right? So they do the National Recovery Administration or the Civilian Conservation Corps, or pack the Supreme Court, or revalue gold, which actually did work. And some of the things worked, some of them didn't. But the theory was try something and see what happens.
Yeah.
Well, this creates what Kindleberger called regime uncertainty. And by the way, we're in that condition today. This kind of goes to the recession thesis.
Regime uncertainty?
Regime uncertainty, because everybody knows what caused the Great Depression. I mean, that's been pretty well studied. What's always intrigued me is why did it last for 11 years versus the 1920 recession, which was over in, I think, 18 months. And that was the subject of Jim Grant's book, which is an excellent book, by the way. So what was the policy response to the recession in 1919, 1920? Balance the budget, do nothing. And we were out of it in 18 months. Thank you, Warren Harding. So what was the policy response to the 1929 crash? Do everything, and it lasted 11 years. But the reason is capital goes on strike. Capital is like, I don't know what, I mean, from today's perspective, Do you know what your healthcare? You're a businessman. Do you know what your healthcare costs are going to be? Do you know what your taxes are going to be? Do you know what environmental regulation is going to be? You know, et cetera. No, you have no idea.
Yeah.
Because so what capital says is, okay, I'm going to the sidelines. Call me when it's over, and then I'll reinvest. So today, this famous tax bill. By the way, I watched this. I watched the stock market go up. So I'll use the Dow. It goes up 1,000 points in November because of the Trump tax cuts. Then it goes up 1,000 points in December on the Trump tax cuts. And then it goes up 1,000 points in January on the Trump tax cuts. It was like, you just priced the tax cut in 3 times. He's not going to cut taxes 3 times. He's going to cut taxes once, but the market priced it in 3 times. That's almost a,
well, yesterday,
bubble.
Mnuchin said he'd be very soon.
Details, yeah, but they're not going to get it done until November at the earliest if they're lucky. By the way, the last time the tax code went through a major overhaul was 1986. The time before that was 1954, and the time before that was 1939. Mm-hmm. So the tempo is these things happen every 30 years. It's a big deal to do what they're trying to do. Not going to get it done certainly by summer. But the thing is, initially I was kind of like, well, guys, if you got it done in May, you could, because what Reagan did, he said, we're going to make everything retroactive to January 1st. Mm-hmm. So you can make your decisions now. If there's some benefits, you won't lose them. We'll make it retroactive. Well, if you don't get it done until December or November, which looks like the earliest, that's going to be effective January 1, 2018. Mm-hmm. So you've already lost a whole year. The market priced in a whole year, 2017, of increased earnings per share based on tax cuts that they're not getting. Mm. So is there a correction for that? I haven't seen it. So now, but what is a drag on growth is 2 big things are in play. Deductibility of interest expense, mm-hmm. and expensing of capital equipment. Because you buy something, you get it right off over 4 years, you can expense it in year 1, right? We don't know what the Congress is going to do. They're mm-hmm. talking about eliminating the deduction for interest expense and allowing.
You mean the mortgage deduction?
No, not well. That's in play also, but no, I'm talking about corporate business expense. Okay. And modern financial theory says there's no difference between debt and equity except tax deductions. Mm-hmm. That's the only difference between debt and equity. And so the tax deductions would cause them to be priced differently and cause corporate treasurers and CFOs to have a preference for one over the other. Well, you take away the interest expense deduction for corporate interest, that's a very big deal.
Big deal.
Same thing. So corporations are saying, okay, I don't know whether my interest expense is deductible, so I'm not going to borrow. I don't know whether I'm going to expense or not be able to expense my equipment, so I'm not going to invest. Mm-hmm. I'm going to wait. Mm-hmm. So investment's hitting the wall. Commercial loan creation is dropping precipitously, but this is because real business people in the real world don't know what the deal is.
Right.
This is regime uncertainty. This is going to kill growth this year, among other things, plus the Fed tightening. And we'll see what happens next year.
It's also why I don't disagree with that, by the way. I mean, we have our Washington policy team. We bought Potomac mm-hmm. Research Group. Mm-hmm. And I go meeting to meeting saying, yes, I'm buying the NASDAQ. I'm buying growth stocks because I think profits accelerate in Q1, Q2. I think GDP continues to accelerate off the lows. And if you have concerns about Trump not getting it done, I'll give you 10 more. Because I have 13 people there that are going to give me that every single day.
Yeah.
So it's kind of it's been an interesting, as you know, I'm not some permabull, but I almost use that as a bear. I think that if you look at implied volatility premiums in the market, for mm-hmm. example, or any reasonable measure, the Russell 2000 is a net short position. If you look at CFTC futures and options contracts, I think that the market's concerns are correct if they are political concerns, because there's no reasonable person that's got a team in Washington that would tell you that this is going to get done in May.
Right.
Not even close.
But what happened to Steve Bannon's $1 trillion infrastructure plan?
Right, that's not there.
So it's not there. And then now the most recent was, maybe it'll be $400 billion. Yeah. And by the way, the Congress, I don't get the tax thing. I mean, I understand the technicals, but the Congress said any tax cuts have to be revenue neutral. So if you want to take personal income taxes from 39 to 33 and corporate taxes from 35 to 25, you've got to pay for that.
Yeah.
So they're looking at mortgage interest expense. They're looking at carried interest on it. They're looking at a lot of things. Well,
because it's so we have Paul Ryan's just most recently chief of staff. He just left, and we have him on retainer.
Okay.
So his name's Hoppy. David Hoppy would basically say that there are 2 third rails that you cannot touch if you want to get anything done in the Republican Party. One is abortion, mm-hmm. which was surprising to me what the numbers were in terms of how many people just will not vote for certain things. And then there's the $2 trillion non-balanced budget in 10 years.
Correct.
So that $2 trillion, that's why they keep bringing back this bat, because it takes a big...
They're going to do the bat.
Takes a bat out of the $2 trillion.
So you're saying bat or bat?
No, the bat.
Okay.
That's why they keep talking about the bat, because the bat is attractive because it can reduce the $2 trillion deficit.
My best information is the bat's going to fade, but they're going to do the bat.
The bat, yeah.
The bat.
That's true too.
But because the Congress, by the way, these things don't come out of the blue. The Treasury has had the Treasury's had the VAT tax legislation on the shelf for over 20 years. This is shock doctrine. Naomi Klein. They're just waiting for the opportunity. So these like permanent bureaucrats, they always wanted the VAT, but they know that the American people hate it. Yeah. So they're like, well, they're just looking for a chance. But now they have a chance because if Trump does all the other tax cuts, they'll go, well, that's pretty good. Bring in the VAT. This is the most regressive plan you can think of.
A VAT tax?
Well, if you couple a VAT tax with a cut in the individual income tax rate, because who benefits from going from 39 to 33? Rich people. What's the marginal propensity to consume? It's really low. Like billionaires are already spending all the money they want. Their lifestyle is not going to change if you cut their taxes. They're just going to pay less. You throw a VAT on, who does it affect? The poorest people in the economy, right?
Exactly.
With the highest propensity to consume. So you're going to kill consumption.
People forget the numbers. I mean, first of all, they haven't. It's nothing against them. They're just told this meh all day long. There's no actual numbers. But the median consumer in America, like take somebody like my dad who's a firefighter, makes 50 grand over the years of his life. That's what he makes, and definitely that's where their pensions are at.
Right.
If you take a retired firefighter like my dad, but they make 50 grand and they got to spend 49 just to pay their rent if they rent, or their mortgage, food on the
Medical,
table, gas.
Right.
Yeah, they don't have any room.
Correct.
Nothing.
Right.
And that's, like, to me, the biggest, I do hold Bernanke in contempt for that, because if you didn't have a policy to inflate with devaluing the dollar to a 40-year low, all the things that most human beings need, including their shelter, 24% of the 49,000, if you make 50 and you got to spend your 49, 24% on average is it's the biggest bucket is your rent.
Right.
Or equivalent of it.
Right.
I mean, so we inflated the biggest cost. And over and over and over again.
Right. So throw a value-added tax on the people
on
people you're describing,
right.
And then cut Bill Gates' income tax. Right. He's not going to spend any more money, so you're not going to get any.
Oh, he's going to give his money to them.
You're not going to get any bang for the buck.
Well, we have, and thank you for staying with us. We have, we're going to take a full QA here. So Jim, I hope you don't mind that I could sit here talking to you all day, obviously, but. Maybe I will, but I'll just try to fish through some of these questions. Once Mr. Rickards talked with Geithner about a new way to try to reinflate. What was it about?
I spoke to Secretary Geithner recently. We didn't talk about reinflation. What we talked about, my question to him was, I said, Mr. Secretary, we hope this doesn't happen, but if there were a systemic crisis tomorrow, what would the policy response be? Because the point I make, and I sort of preface this, in the last crisis, the Fed took their balance sheet from $800 billion to $4 trillion,
right.
And they cut rates to zero. The problem is they're still there. They have not normalized, right? So the crisis is long gone. There's plenty of liquidity in the system. They should have started to normalize. In my view, I was on CNBC Squawk Box with Joe Kieran in August 2009.
I thought you were just going to say that you were just on with him last week.
No, I was
not. The probability
not.
of that is low.
Very low.
I think you and I actually together were probably, maybe you're not, maybe they've unbanned you, but
no, I was on 50 times between 2007 and 2011.
That's when I was on.
They lost my number.
I actually invited, we got to get him on. We got to get him on.
Yeah.
And then I guess they both got it.
But I happened to be on August 2009, and there was a Fed meeting, and Kevin Warsh was there, and Joe said, what should the Fed do? She said, they should raise rates, 25 basis points. Tiny, make it clear this is not like an aggressive tightening. But I said, there's no liquidity crisis. I've never seen so much money. Now, unemployment was 10%. The economy was pumped.
Right.
But there was no reason not to normalize. Anyway, the point with the conversation with Geithner, I said, okay, if the Fed had somehow got the balance sheet back to $800 billion, I'll give them $1 trillion, right? I'd be the first one to say, nice job, guys. You saved the world and you normalized. But they didn't. So I said, what are they going to do? Go to $8 trillion? $12 trillion? Where's the invisible confidence boundary where people just say, like, oh, this is a joke, I'm out of here, I'm out of the dollar? Or will they go to SDRs? In other words, because the IMF has a clean balance sheet. They're leveraged 3-to-1. They could print, a couple trillion SDRs. They're worth about $1.50 each, and just flood the zone with those. I said, so what's it going to be? He said, neither, and this surprised me because I thought he would say some nice things about the SDR because he's a SICE guy and worked at the IMF, and he knows. He's one of a handful of people in the world who actually understand SDRs.
That's all he's ever done.
Right.
His work on these things.
But he didn't, although I don't know if he was being cagey or not. He said they're going to use guarantees. So, because this is my Einstein scenario, and you're going to have to do massive redemptions. Money market funds, you're going to have to close the money market funds, and people will go to the banks, and they'll have to close the banks, and then they'll sell stocks, and you have to close the stock market. You have to lock down the whole system. Because the demand for liquidity just moves from vertical to vertical, and you have to lock them all down. So that's ICE 9. And this all happened before, by the way. So
we have a question on ICE 9, by the way.
Okay, well,
your
I'm sort of jumping ahead. So he said, no, what we'll do is we'll just guarantee everything.
He said that?
Yeah, which they did do
effectively, yeah.
To some extent. Well, no, they guaranteed every money market fund in America after that reserve fund or whatever broke the buck around the time of Lehman. They didn't have to. That's not the law. They guaranteed every money market fund in America. They guaranteed every bank deposit in America in excess of the insured limit. You had $250 at the time. They said, hey, you're a small businessman. You got $1 million in the bank today, guaranteed. So, and that kind of worked. And then they took the balance sheet up and they did all this other stuff. So I thought that was interesting because he's a super elite. He talks to Lagarde and he hangs out with the Davos crowd and he's very plugged in. And so to me, that's not just one person's opinion. That's the distilled wisdom of the super elites. So I'm thinking to myself, well, okay, but I'm positing the point I make in my book, The Road to Ruin, is in 1998, Wall Street bailed out a hedge fund. In 2008, the central banks bailed out Wall Street. In 2018, if not sooner, who's going to bail out the central banks? In other words, each crisis gets bigger than the one before. Each bailout gets bigger than the one before. If the central banks are the eye of the storm, if they're the institutions we're losing confidence in, if the government is the institution we're losing confidence in, what good is the government guarantee? As the entity it's like getting insurance from AIG in October 2008. You don't want insurance from AIG because they're going bankrupt. So any guarantee, which is a form of insurance, is only as good as the person giving you the guarantee. And if there's a crisis of confidence in the government, in fiat money, in central bank money, then it's not clear to me that the guarantee will actually work as expected. So you may get back to SDRs. But
well, on the way, it's all about the rate of change and the behavioral factors on the way to the guarantee.
Correct.
You don't get the guarantee unless you have some version of bedlam.
Correct.
I mean, so that's, I mean, to be clear, for me, all I need to do is start to see growth slowing before I go there. I mean, it's not that complicated. All this happens when you have growth slowing. So I think that's actually a fair. I mean, it's a fair argument.
Yeah, although I would separate business cycles from panics.
Yeah.
Now, sometimes they go together. 1929, 2008, they went together, but in October 1987, September 1998, we had financial panics, came very close to blowing up the whole system, but there wasn't a recession. And in 1989 and 2000, we had business cycle recessions with no panic.
Right.
So sometimes they're separate. But sometimes they happen together.
Yep. Okay, on ICE 9, I'm in the commodity agricultural industry, particularly in regards to commodity grains. I'd like to know, will ICE 9 affect things like the CBOT or the CME? Also, lending is a dire necessity for country grain elevators who purchase grain from farmers on credit. Would an ICE 9 event prevent these elevators from purchasing grain? That would be dramatic. That would have dramatic implications for the food security of the U.S.
Sure. The most vulnerable contract is the COMEX gold futures. That one you can forget that. They're just going to shut down the exchange because that could happen tomorrow. You don't need a full-on panic.
By the way, before you go on, can you just remind people the Kurt Vonnegut metaphor?
Sure. So ICE 9 is a concept that I stole from Kurt Vonnegut, but that's what authors do. You build on what's there. So Kurt Vonnegut, a great novelist, wrote a novel in 1962 called Cat's Cradle. And the premise of the novel is there's this PhD physicist, and he invented a polymorph of water, very similar to a water molecule. He called ICE 9, but there were two differences between it and H2O. One is it's frozen at room temperature, so the boiling point or the melting point is 114 degrees Fahrenheit. The second one is that when a molecule of ICE 9 comes in contact with a molecule of H2O, the water turns to ICE 9. So he puts it in vials, 3 vials, gives it to his 3 children. So the plot of the novel is, what do the kids do with the vials of ICE 9? And it's a doomsday machine. So if you open it and pour it into a stream, the stream's going to freeze. And then the estuary, then then the ocean, then all the water in the world will freeze, the entire planet will freeze, and life on Earth will die. So it's a doomsday machine. So all I did is I took that and I imported it over to financial markets, and it goes to the point I raised earlier, which is in a full-on, the best description of a financial panic I've ever heard is everybody wants his money back. Because you run into these rich people and they're like, I got money in the stock market, I got money in the bond market, I got money in the real estate market. I said, no, you don't. You have stocks, bonds, and real estate. You don't have money. If you want money, you got to go sell that stuff and get the money.
The liquidity.
Well, right. And so everybody wants their money back, meaning everybody wants to sell everything at once, and that's the best definition. So where's the money going to come from? Secretary Gartner says guarantees. I think Madame Lagarde might say SDRs. But either one of those things will take time. See, this is the point. They will take time. So how do you buy time? What do you do for the first couple of months? Because the last time, the panic hit in September 15th, 2008. Lehman Brothers went bankrupt. And then AIG, the TARP got voted down. That was the height of the panic. There was 2 weeks at the end of September 2008. The IMF didn't issue SDRs until August 2009. I might have been the only guy who noticed that they issued SDRs, but they did. I'm like, okay, guys, it took you 11 months to get around to issuing SDRs. Even if you put that on a fast track, it's got to be 3 or 4 months and to reliquefy the world. And what are you going to do in those 3 or 4 months?
Well, this is why the metaphor is applicable and why he's asking, would the CBOT or the CME shut down? Because what else are they going to do?
Right. The risk in those, look, I think on the face of it, it shouldn't affect, corn and wheat and lumber and all this other stuff, but although it will affect gold. People they will go right for gold. They'll find out that there's nowhere near, there's only about, for all the paper gold that's, paper gold that's out there, there's only about 1% cover. So they'll just close down that contract.
You've done a lot of work on that.
Yeah, and they'll just give you yesterday's price. You're like, wait a second, I want today's price. Screaming, it's up $500 an ounce. Like, no, sorry, we closed you out, closed the business yesterday. Here's your check. Nice knowing you. And the London Bullion Market Association banks will do the same thing with their unallocated gold forward contracts and ETFs. They'll all shut down. But the risk really is clearinghouse risk, because what people who trade these commodity futures. When you trade a future, you don't deal with the guy on the other side of the trade. You deal with the exchange, and he deals with the exchange, and so then you have a clearinghouse guarantee. Mm-hmm. See, I think this is what Geithner might have been getting at, which is you're going to, because the risk, because when you move risk from the exchange to the clearinghouse, the risk doesn't go away. You just put it in a different place.
Exactly.
And you may have to go guarantee the clearinghouses. That was the problem in '87. Bankers Trust was supposed to wire $1 billion cash to the Chicago Board of Trade, and they didn't want to send the money because they weren't sure that those guys were going to be there. And the Fed called them up and said, "Send the money," and they did. And then they got their money back, and life went on. But people in these panics, they balk. They just balk. Like, I'm not sending the money.
See, this is why we listen to Jim Rickards. You can forget more on the way to the bathroom in terms of what happened in 1987 than most people know. So as a follow-on to that, actually, I bet you, Jim, if I just cherry-pick the questions off of the last 2 sentences you say, I'll find the next follow-on question. So in a situation, actually, that you just described, he didn't say it that way, but he said in a situation where gold surges in response to monetary policy following a crisis, will we see temporary deflation and a drop in the price of gold before it surges?
Well,
that's the 08 scenario.
Yeah, the history is that in the immediate early stages of a panic, gold goes down, and the reason is, in a panic, in a liquidity crisis, you don't sell what you want; you sell what you can.
Yeah, it's a source of funds.
Right. So, like in 2008, all the guys who wanted to sell mortgages couldn't sell mortgages, so they sold gold if they had some, and they got cash. But that's temporary. That goes down and then it goes back up like this, because then the strong hands come in and say, "Give me the gold."
Mm-hmm. Well, I mean, this is I've thought about this a lot. I mean, because I've lived through more than a few at this point. I mean, I've been doing it for 18 years, so I'm just one of these guys. If you're in your early 40s, mid 40s, and you run money, you see markets crash all the time.
Yeah.
So when that kind of a situation happens that this guy's asking about, the same applies to the FANG. So if you see that developing. People sell what they can, not what they should. There's a lot of FANG to sell. Short that.
Right.
Try to. It's actually an odd thing to say potentially, but the way you hedge your gold, if you believe in that 10% position or whatever your position may be that you don't want to get rid of, or just not take the drawdown risk, just short FANG.
Yeah.
That's what everybody owns.
Right.
There's going to be no short interest in this stuff pretty soon.
Right.
I mean, can you imagine being short this stuff right now? Stuff doesn't go down.
Yeah, I know.
I think Paul Tudor Jones today called it something. I mean, whatever.
He said he had a chart, and he said if Janet Yellen saw this chart, she should be scared to death. That's
terrified.
Yeah, that's what Paul Jones
So I
said.
said over to Darius, I said that means that Paul's probably short the NASDAQ right now, and that's pretty terrifying. But the reality is that he's going to be right.
Well, but I don't necessarily get short these things. I don't like being long. See, you've made a lot of money for your clients the last 5 months. There's no question about it. No, you have. But I'm saying, well, maybe you were right for the wrong reason, which is that it's a bubble, and you can make a lot of money in a bubble. Alan Greenspan called a bubble in 1996. It didn't pop until 2000. Yeah. That's a long time to be on the sidelines.
No, it's kind of the lesson of, and I know you deal in this space, but if you look at the market in terms of where implied volatility is, like is it trading at a premium or a discount? Mm-hmm. When markets have an implied volatility discount, that's the perfect time to short a market. Mm-hmm. That is the utter and perfect example of complacency.
Right.
The forward outlook is what happened yesterday, which is nothing goes down.
Yeah.
But in the only thing, this is the first time, Jim, that I've been long a bubble, like profiting from a bubble. It's like almost ridiculous. I mean, for me to say that Amazon doesn't have a bubble multiple is just absurd. Mm-hmm. But it's fun until it isn't. Anyway.
But to your point, this is what you do at Headshot. You have to wake up every day and wrestle to the ground. This is not a set it and forget it. And I'll tell people that I'll say something, have a recommendation, and then 6 months later it's going the other way, and I go, "You're an idiot." I say, "No, haven't you been listening to me every day? I mean, I said, do this, then do that, and you have to be nimble." You cannot set it and forget it. You've got to wake up every day and just kind of confront this.
You got to grind through it. A lot of compliments for you. Keep fighting the good fight, Jim. So now you're getting the love, man. So as soon as
I'll go home and go on Twitter, and it'll be all on my Facebook. That's nice. Thank you.
So Jim, you got Brexit right. You got Trump right. Now, if you're my man, you got to tell me who wins in France.
Well, you know what? I was running around the world in the days before November 8th saying Trump's going to win. And I got all those videos, and same thing with Brexit.
You're one of the few.
I would say that. I was on with Francine Lacqua at Bloomberg, who's a very nice lady, by the way.
She's cool.
She gasped. I said, Trump's going, what, are the polls wrong? Or what? And she's being a pro, but I was like, yeah, the polls are wrong, and let me tell you why. But it goes back to your point, Keith, about I don't particularly have high regard for people who make claims, unless you tell me your method. Yeah. I don't want to debate your claim. I want to debate your method, because that's where the flaws are going to be, if there are flaws, or that's where you're going to convince me. So there was a method to that. But here's the thing with the French election. I'm just going to be honest. I'm not afraid to make out-of-consensus calls or unpopular calls if I can see it, and I could with Brexit and I could with Trump. This one is genuinely too close to call. I mean, I'm going to go with consensus, say, Macron and Le Pen. But there are four leading candidates. They're all neck and neck in the polls. There's a 30% undecided, and we had a terrorist attack yesterday. That's jump ball.
Yep.
So with four candidates, you have six possible outcomes for the runoff. So if it's Macron, Le Pen, probably Macron wins, and it's all good. But if it's Le Pen, Mélenchon, now you've got the far right against the far left.
Wow.
How's that going to play out?
That'd be wild.
Well, then a lot of people stay home, but if they all stay home, Le Pen could win, or Mélenchon could win. Mélenchon's more radical than Le Pen.
Oh yeah.
I mean, look at what he's advocating. And then does Fillon sneak in there somehow? Is Fillon Macron? Who knows? But it could really. What I've said to my readers is, okay, I got six possible outcomes. A couple of them, they all end up being okay for the euro. Here's the opportunity. So
I agree with that.
Let's put this in.
Right before this meeting, I covered my euro short, and I sold my NASDAQ.
Yeah, I like the euro. So
because it's like the scenarios. Actually, go ahead.
I was going to make the point that. So let's just say it's Le Pen, Mélenchon, right? I think we could guess that the euro is going to plunge on Monday. Okay.
Oh yeah.
I'm a buyer. Here's why. Because Le Pen cannot just wave her hand and say we're out of the euro. She said what she said is I'm going to have a referendum
to process it.
If you look at the polls on the referendum, 60% of the French people favor the euro, and this is why I was singing, Rubini and Krugman and Stiglitz and all these guys starting in 2010.
Yep.
They all said, "Oh, the euro is falling apart. Greece is getting kicked out. Spain should quit. Go back to the peseta. Devalue. Lower your labor costs. Northern tier, southern tier." And I said, Nonsense. Nobody's leaving. The euro's here to stay. It's a Hotel California. You can't check out. And they'll add members. And in fact, that was correct. When I said that, they had 16 members. Today they have 19. They'll have 20 when Scotland joins. But the point is, the Greek people, at the height of the Greek crisis, when they wanted to march into Berlin and burn the place to the ground, 60% of the Greek people favored the euro because they remember the drachma. The drachma was nothing more than a device for the elites to steal their money. The Italians remember the lira. Yeah. The Spanish remember the peseta. The French remember the franc. None of them want to go back to that.
No.
So even if these nationalists, because the reason Le Pen's got strength, it's nothing to do with the euro. It has to do with immigration. So that's, if she wins, it's on the immigration.
Well, that's why Macron's, is it like his most thoughtful thing, I think, was holding that flag of the euro.
Yeah.
Like, because that is a popular thing, and it's also a daunting thing for people to consider losing that stability.
They don't want to leave the EU or the euro, but if she wins, it'll be because of immigration, and then she'll have a referendum. The referendum will lose, and you're still in the euro. So it could be a good buying opportunity.
All right. I'm a Canadian. This Canadian, you want to get in here? You tell me you're Canadian. I'm definitely letting you get this Q&A is huge. You have so many questions, and they're so broad, which speaks to how good you are. I mean, you answer with specificity and process, obviously. So I'm a Canadian, and I'm looking to buy 10% of my portfolio in gold via Sprott Physical Gold. Is it better I buy it from U.S. listings or in Canadian dollars on the Toronto listing, or does it even matter?
Yeah, look, I'm bullish on gold. I'm not going to get into recommending specific. I know Eric Sprott. I know Rick Rule. I know this guy. They're good guys. I like them as a firm. I don't want to get in the business of recommending specific tickers.
I do think that the bigger question, though, is like people really do struggle with how to execute. Like
Absolutely.
So if you're Canadian and you want to take 10% of your, what would you do?
I'd buy physical gold. I'd buy Maple Leafs or bars.
That's what you've always done.
I'd buy bars from the Royal Mint of Canada. I'd buy Maple Leafs. Put them in non-bank storage. There's a high conditional correlation between the time you really want your gold and when the banks are closed. So don't put them in a bank. And I was in Zurich talking to non-bank secure logistics people, but the people with the vaults basically. They can't build them fast enough. And they said they're ultras, they're ultra high net worth. They're taking their gold out of Deutsche Bank, UBS, and Credit Suisse, and they're moving it over to whether it be Loomis or any other non-bank operator. It's the same gold. There's no more or less gold, but they're getting it out of the banking system. So I would say physical gold, non-bank storage, safe place. I'm not dinging anybody, but all the paper gold is vulnerable as far as I'm concerned.
Yeah, you've been consistent in saying that. Here's a good, I don't know, I didn't even know this book existed, so maybe I should read it. I just read the book Gold Warriors, which led me to believe that there is much more gold, Jim, than we think is in existence. Some 80,000 tons was sacked by the Japanese from Asia, China, Korea, Malaysia during the turn of the century and was hidden in the Philippines and later recovered. Have you heard of this story? And if so, do you believe it at all, or have you heard of anything substantial to this?
This is the Yamashita gold named after General Yamashita. I've heard the story. I've seen. Here's the thing. Interesting story. Zero evidence. It's like aliens.
It's like my son's watching. We're at a hockey tournament. And this History Channel thing on Fort Knox, how the gold's not there?
Yeah.
Like, he definitely believes it's not there.
Right. Look, I have an open mind. If I get I'm in Bayesian. If I get new data, I'll update my priors, right? But
zero evidence?
Zero evidence.
How the hell does a guy write a book called Gold Warriors with no evidence?
It's a free country. You can write any book you want. I mean,
you could probably skewer this book.
I wouldn't waste my time, but maybe. Yeah. The thing is, where's your? Where's your? Oh, I only have one question. Thanks, Keith. I have an open mind. I only have one question. Where's your evidence? Now, there are interesting stories where we have facts, right?
Yeah.
Gaddafi had 100 tons of gold. He was running around the desert with 100 tons, right? It's not 80,000 or whatever. This guy had 80,000 tons. I don't know what. That's like half the gold in the whole world since the beginning of time. But leave that to one side.
And he did say and he said this is how things get around. Some 80. That's kind of like whatever. Some 80,000 tons.
That is about half the estimated entire supply of above ground gold in the entire history of the world. Okay, if that's out there, I'll change my math. But zero evidence. There is Gaddafi did have 100 tons. He was running around the desert with it. That has been taken by NATO because they whacked him and put in a secure place in trust for the Libyan people. But where is that gold actually? I don't know. Well, I mean, I know NATO got it, but I don't know where it is now. Whether it's been rehypothecated to the market, maybe. I talked to the number 2 person at the IMF. They sold. It's around 2010, 2011. They sold 400 tons. I love the fact that the IMF disparages gold, but they have 3,000 tons. Like,
oh, boy.
Hey, IMF, what are you doing with 3,000 tons of gold if it's a barbarous relic?
Since you might know this, like who individually, because you mentioned Gaddafi, do you know who owns the most physical gold? One person?
Well, the United States is 8,000 tons, and so I would say.
No, I mean, one human being.
One human being. No.
Wouldn't you brag about that?
Well, Stan Druckenmiller.
Yeah,
Stan
he must have
Druckenmiller. He had a lot in his family office. I don't know who the biggest individual gold holder is. It's an interesting question. Maybe I'll look into that. But I think of gold. By the way, in terms of our Canadian friends, I spent 3 days in Montreal at the beginning of this week. I was up there Monday, Tuesday, Wednesday,
really?
visiting gold mines. I was in a place called, by the way, my French is awful, so forgive me, but Val d'Or, which is in northern Quebec, and then like a 3-hour ride on dirt roads from there, out visiting gold mines. For this 80,000-ton guy, I mean, there's gold there, but it's like flex. You got the gold miners talk about it in terms of grams per ton. If you have 5 grams per ton, that's pretty rich. So, but think of a ton of rock, something that would fill this room, and you crunch it all down, and you leach it with cyanide, and you melt it all down, and you get a gram, which is about this big. That's what miners do. They get a gram of gold out of a ton of rock, or maybe 5 grams or whatever. That's how scarce it is.
Yeah.
You've heard of rare earths?
Yep.
Gold is way more rare than rare earths.
So you've seen Josh. You know Josh Crum?
I do know Josh. He's a good guy.
He does a great job on that side of it. That's why, you're the great gold historian. All he really focuses on is what does it cost to get that rock to what you see it to be, and he always carries around gold. And he does a tremendous amount of work on the input costs to take it to production. And it really gives you a real fine appreciation of the the scarcity value of the element.
By the way, I spoke to the former deputy finance minister of Japan, Saki Kibara, Mr. Yen, so Saki Kibara, and he was in the 80s. That was his day, and he told me how Japan manipulated the gold market because they wanted to buy 300 tons to strike I think it was a 70th anniversary coin for Emperor Hirohito. So they wanted to strike a coin in honor of the emperor, and they needed 300 tons of gold to do it. So he's like, but that has huge market impact. So it was how do you buy 300 tons without driving the price up? Because they didn't want
Drive
that.
it down.
So they were manipulating gold futures and all this stuff, which is pretty easy. But so I'm like, well, gee, why did they have to manipulate the market for 300 tons if they have 80,000 tons? They doubt they have 80,000 tons.
Do you have time for 1 or 2 more?
Sure.
This is a good question. I don't know the answer. It's based on Ray Dalio's current view on populism, which I'm sure you've read. Wouldn't that be another bullish long-term A, do you agree with it? And B, wouldn't that be another long-term bullish catalyst for gold?
By the way, I haven't read it. I've skimmed it, but I was like, if I want to understand populism, I don't need to read Ray Dalio. I can read. There's a library full of books going back to the progressive era.
I appreciate that. That's just to make a side point there. I'm far less read than you are, but I'll say that too. Where if I've done my work, I don't have to ask Ray.
Right.
It doesn't that's not meant to be disrespectful. It's just if you have your own framework, you go do your own reading to backfill your framework.
Right.
And that's basically what you do. You read more than anybody I know. So,
except for you, maybe. But they,
right. But on populism, so how would you just take populism then? How would you take it?
Look, I think the kind of potential for social unrest is a very big deal.
Well, it has been.
Yeah, and I think it's getting worse. The income inequality, I'm not like a socialist spread the wealth, but I just look at the data, and the Gini coefficient of the United States is now tied with Mexico. When I grew up, Mexico was the ultimate oligarchical society. Gini coefficient being a measure of income inequality. Yep. And all during and Robert Gordon does a good job of this, all during the 19th century, we were losing agricultural jobs that you wouldn't quit, but you could go get a manufacturing job. Mm-hmm. All you had to do was move from the farm to the factory or from the country to the city, but you could get the job. Even as late as the 1980s, when Detroit and the auto industry was collapsing, a lot of people just packed up the car and moved to Texas and got a job with Dell. So the history is, Schumpeterian creative destruction. You know, we destroy jobs, but we create them. That is not happening now. We're destroying jobs and we're not creating them. You know, upwards of 45 million people on food stamps. You know, disability. By the way, you can, if you go on a disability, you can get Medicare after 2 years regardless of age. So you go on disability when you're 45, you can get Medicare when you're 47. You don't have to wait till you're 65 or whatever. So we see this in labor force participation. By the way, one of the big memes is BGI, Basic Guaranteed Income. It basically says we're going to pay people just because, not pay people not to work. And that's coming, and the reason you know it's coming is because you hear it from Bernie Sanders and Charles Murray. Charles Murray is a brilliant intellectual thought leader of the right. Bernie Sanders, political figure on the left. Whenever you see the left and right agree on something, it's coming. And you know, more and more people are kind of buying into it. But what it says is we're done creating jobs. We're just going to pay you.
Yeah, that's somewhat in line with, you may or may not be familiar with Neil Howe's view of a fourth turn.
Yeah.
Is that, you know, populism really hits a crescendo, and for a lot of fundamental reasons that are generational, if anything else.
Right. But let's just take it a step further, because this is really what I do. Like you project things up, just keep going, okay?
Yeah, keep going, going and going.
If you get to that point, well, Ice 9 is an example, just keep going. But we've seen this play out many times. When populism, social unrest, disorder, chaos, they're rioting in Berkeley because Ann Coulter is like a skinny blonde, wants to give a speech. You know, I mean, let her talk, right? But when things get that out of control, there's pushback. There's a neo-fascist response. Look at your local police force. When I was a kid, you know, cops would get a kitten out of a tree for a little girl, right? Today, they're Kevlar armor, night vision goggles, flashbang grenades, armored personnel carriers. I don't care if U.S. Special Operations Command has that because they're trained. But your average Barney Fife running around with armored personnel carriers and machine guns and stuff is a little frightening, and they're banging down doors and killing people left and right to serve warrants. You just knock on the door, here's your warrant, show up to court. Now they it's like a SEAL Team 6, right? But they're not trained. They're killing people. So, but the point is, under the Posse Comitatus Act, you cannot turn the military into a police force by local order. The president can do it, but you can't do it. But what they've done instead is they turn the police force into the military. So the neo-fascist response is waiting in the wings. By the way, when I say fascist, it could be left or right wing. It's left-wing fascist, right-wing fascist. It's not really an ideological statement.
Okay, last one, and you called this out in the, we had a ton of feedback on it, the Jim Rickards 21.
Oh, yeah.
Some of your answers were awesome. But one of your answers was the biggest risk. You actually picked North Korea.
Oh, yeah.
So, and that's an interesting one because General Dan Chrisman, who ran West Point, he's our chief geopolitical strategist in Washington. He would say the same thing.
Well, here's why. What do you have to do? You have to get fissile material. You have to enrich it, master the enrichment cycle for uranium or plutonium. You have to weaponize it. By the way, whenever you hear the phrase nuclear device, a nuclear device can be the size of a truck. So North Korea can blow up something the size of a truck and cause a chain reaction and a big explosion. But to weaponize it, get it down, they'll fit in a warhead, you have to ruggedize it, which means the thing goes into space. Right? So, it's a lot of stress. So it's going to be ruggedized, miniaturized, weaponized. Then you need missiles. So North Korea has short-range missiles. They pretty much mastered the intermediate-range missile. They don't have an ICBM. They're working on it, but they're working on the miniaturization. My point is, one by one, they're knocking down all the obstacles.
Right.
They're clearing all these hurdles, and they've got good scientists. By the way, they're selling this stuff to Iran, and they're being paid in gold. They can't exactly send a wire through SWIFT, right? There's no message. There's no North Korean message traffic going through SWIFT these days. But you can put gold on a plane and send it to North Korea, which is what they're doing. It's
Interesting.
What I call the axis of gold. It's Russia, China, Iran, Turkey, with North Korea as a junior member. But there's all this gold moving around among adversaries of the United States because they know we freeze seas and don't say please in terms of the payment systems. That's another bullish factor for gold, coming back to the point. So that's where they are. They're probably 3 years, maybe less, away from being able to nuke Los Angeles and kill 3 million Americans. It's just a fact. So
3 years?
3 years, yeah. They're very far along today. They may be further along than we think, but let's just say 3 years, okay? They will not be allowed to do that. The United States is not going to gamble with Los Angeles. We're not even going to take a fraction of 1% chance that they can actually fire a nuke at LA. Not happening. Therefore, we will destroy their program unless they're deterred, unless they verifiably steer away. There's no evidence that they're steering away. Why is that? Look at U.S. foreign policy. So Gaddafi had a nuclear weapons program. He did. He gave it up. Mike Morrell, CIA, goes over to the Tripoli, and they gave it up. Saddam had a nuclear weapons program. He gave it up. He didn't have it when we went in 2003, but he had it in the 90s, and that's a fact. He gave it up. So Gaddafi got a bullet in the eye. Saddam got hanged. The Iranians have a nuclear weapons program. They didn't give it up, and they're still standing. So Kim Jong-un is sitting there saying, well, the lesson is if you give up your nukes, you get whacked, bullet in the eye, or hanged. But if you don't, you're still standing. So his conclusion from looking at American behavior, we're sending all the wrong signals, by the way, is that keep your program, they won't mess with you. And he said that the other day, don't mess with me. That's what he thinks. Most wars happen, Keith, not because anybody wants them, but because of miscalculation. Two sides misread each other. So Kim Jong-un's going down a path where he says, my security, continuation of my regime, my personal safety is based on having this program. The U.S. is in a mode where we said, you can't have the program, so there's going to be a war. And now the only other player is China, and we want China to do something about North Korea, but they're not. I mean, okay, coal exports, big deal. They deployed some PLA troops to the Yalu River, that's for show. They haven't actually done much. And they're standing in the way of deploying the THAAD, the Terminal High Altitude Air Defense System in North Korea, which could actually, in South Korea, which could shoot down a North Korean missile. The Chinese don't want that because they're like, well, you could shoot down Chinese missiles too. Right. So China's just playing nice with Trump because of the whole, Trump traded currency manipulation status for help with North Korea, but he's going to find just disappointment that China won't do that much. Because if they do, North Korea will open the border and let 2 million starving people run into Manchuria, which will destabilize China. So it doesn't work out. And so basically, you're on a collision course. Trump means it. He's serious. By the way, this Moab in Afghanistan, the cruise missiles in Syria, target practice. These are just live. I mean, the serious things. I'm not belittling them, nor belittling the gas attack. But the military, you got to use these weapons every now and then. You can't just let them gather dust. So those are both messages to North Korea. Look what we can do. We're serious. Sending the Vinson. Kind of, he was the wrong way, Trump, they were heading south, but now they turned around. The Vinson, the aircraft carrier strike group is heading to the Western Pacific. Trump is serious. Kim Jong-un doesn't believe him. Kim Jong-un will not be deterred because his own safety is at risk, and Trump said, we're not gambling with LA. So you're going to have a war.
The thought actually that, so back and forth, so we have two actually retired generals. One served with Mattis. Emo Gardner was first brigadier general in the Marines with Mattis when they were coming up the ranks. And he'd say, risk number one to Mattis, who's not a Pacific general, he's a Middle Eastern general, is North Korea. In meetings, and interestingly, maybe ironically, we were in LA, we were having a meeting, General Gardner and I, and he pointed over the mountains, and we were in Pasadena. He said, do you see it over there? I was looking over there anywhere, it's beautiful. I said, he said, that's how close North Korea is to rolling it out of a cave and launching it into the middle of Seoul.
Right.
And he goes, that is the real threat. I mean, and then he'd go on to say that really, unless you engage the U.S. that way, which he doesn't want to do, you can't only get to North Korea through China.
Right.
Is that right?
Yeah, no, I've been, a couple things. Now, I've been to Seoul a number of times. It's up on the border with North Korea, very close to the DMZ. It'd be nice if they were in Busan. They're an easy artillery range of North Korea.
Right, so what you're talking about on the LA risk, he'd say that there's already a 30 to 60 mile capability that they have to
absolutely.
Launch it in the middle.
Seoul is completely vulnerable. It's a huge city. Interestingly, North Korea has a small border with Russia, 19 miles, and they're running a railroad through there, so you can do a little end run around China. But that's right. If it escalates to a point where, if Kim Jong-un thinks that the threat of attack by the U.S. is imminent, does he just unleash all his fury on South Korea? In which case, it makes the our attack guaranteed, but you have the benefit of a preemptive attack. The guy who shoots first usually has a big advantage. So I don't see any good outcomes. Unless Kim Jong-un, disappears.
No, this is definitely one to keep front center, and that's interesting. Now we all know why Jim Rickards put it at the top of his list.
Yeah.
So. Well, thank you.
Thank you, Keith.
And thanks for staying so long. We can go on and on and on. I'm sure there actually are plenty of questions, but thank you as well to all of you who tuned in. We very much appreciate it. You can find Jim Rickards at James G. Rickards on Twitter. I know that handle off by heart because I follow it very closely, and you should too. So again, thank you very much, and we'll see you again next time.